Morgan Stanley just released their latest market forecast, and it's making headlines everywhere. They're calling for another massive bull run in 2026. According to their analysts, the S&P 500 could hit new all-time highs. Technology stocks are going to soar to unprecedented levels. Innovation is accelerating. Consumer spending remains resilient. Corporate earnings are going to explode. This is your golden opportunity to get in before the next big wave, they say. The wealth creation opportunity of the decade is right in front of you. But here's what they're not telling you. Here's what they're leaving out of those glossy reports and confident television appearances. This isn't a forecast. This isn't friendly advice from your financial ally. This is a carefully orchestrated trap. And if you fall for it, if you take the bait and dive in with both feet right now, you'll be the one holding the bag when the music finally stops playing. Today, I'm going to show you exactly why Morgan Stanley's bullish call isn't what it seems. I'm going to reveal why this forecast is actually the final warning signal before everything changes. And most importantly, I'm going to show you why the truly smart money, the people who actually understand how this game is played, are already quietly rotating into something completely different, something that Wall Street desperately doesn't want you to buy, something they can't control. Let's talk about what Morgan Stanley is actually saying in their 2026 outlook. Their report is painted in the brightest colors imaginable. They're projecting strong earnings growth across multiple sectors. They're talking about technological innovation that will drive productivity to new heights. They point to resilient consumer spending patterns. They discuss multiple expansion in equities as investors regain confidence. They cite improving economic indicators. They reference stabilizing inflation. Everything in their analysis points in one direction, up, up, and up some more. Sounds absolutely amazing, doesn't it? Sounds like exactly what you want to hear if you're sitting on cash wondering where to invest. Sounds like the opportunity you've been waiting for. But here's the thing about big bank forecasts that you need to understand. They're never really for you. They're never created with your best interests at heart. These forecasts serve a very specific purpose, and that purpose has nothing to do with helping retail investors like you build wealth. These forecasts are for them, for their institutional clients, for the hedge funds, pension funds, and ultra-wealthy individuals who need an exit strategy. Think about this for a moment. Really think about it. When was the last time a major investment bank told retail investors to sell at the top? When did Goldman Sachs, JP Morgan, or Morgan Stanley ever come out and say, "Hey everyone, the market is overvalued, you should probably take your profits now"? It never happens. It has never happened in the history of modern finance. Let's look at the historical pattern, because this isn't new. This is a playbook that's been run over and over again. In 2007, right before the financial crisis that would destroy trillions in wealth, what were the big banks saying? They were telling you that housing was strong. They were recommending financial stocks. They were projecting continued growth. Buy, buy, buy. Just months before everything collapsed. Go back to the year 2000, right before the dot-com bubble burst and vaporized fortunes overnight. What was the narrative? The internet changes everything. Traditional valuation metrics don't matter anymore. This is a new paradigm. Technology stocks will only go higher. Get in now or miss out forever. And then it all came crashing down. Even in 1929, in the days and weeks before the Great Depression began, what were investors being told? That prosperity was just around the corner, that the market had reached a permanently high plateau, that anyone not invested was a fool. We know how that story ended. Every single time, and I mean every single time, the big banks make their most bullish calls right before a collapse. And every single time, it's retail money, your money, the savings of regular working people that provides the exit liquidity for institutional clients who are quietly heading for the exits. So let me break down exactly how this game actually works, because once you see the pattern, you can't unsee it. Phase 1. Institutional money accumulates assets when they're cheap and nobody wants them. This is when the big players are buying. When everyone else is scared, when sentiment is terrible, when the media is doom and gloom, that's when the smart money is quietly accumulating positions. They're patient, they're strategic. They buy when there's blood in the streets. Phase 2. They wait. They sit on these positions as sentiment slowly starts to shift, as prices gradually begin to rise, as the fear starts to fade and is replaced by cautious optimism. They're not in a hurry. They understand that the real money is made in the waiting. Phase 3. This is where we are right now. This is when they start making loud public calls about how bullish they are. The analysts at Morgan Stanley, Goldman Sachs, and JP Morgan start appearing on CNBC with their optimistic forecasts. The research reports get published. The price targets get raised. The media amplifies the message. Suddenly, everyone is talking about how great the market looks. Phase 4. Retail investors, watching CNBC, reading these forecasts, seeing their neighbors make money, finally capitulate to FOMO. They pile in with their savings. Their retirement accounts, money they can't afford to lose. They buy at elevated prices because they don't want to miss out. This is the liquidity the institutions need. Phase 5. The institutions quietly sell to the excited retail crowd and exit at the top. They're not panicking. They're not rushing. They're methodically distributing their positions to eager buyers. By the time the retail investors realize what's happened, the smart money is already gone, already in cash or already positioned for the next cycle. Look at where we are right now in this cycle. Look at the current market conditions with clear eyes. Valuations are at historical extremes. The S&P 500 price-to-earnings ratio is in absolute nosebleed territory. We're looking at valuations that have only been exceeded a handful of times in the past century, and each of those times was followed by significant corrections.
Look at this upward trend here. It could indicate a significant market shift.
The CEOs and executives who run these companies, the people with the most intimate knowledge of their businesses, are dumping their own stock. They're selling at a pace we haven't seen in years. They know something. They're acting on information you don't have. Retail participation is surging. The little guy is all in. Margin debt is elevated. People are borrowing money to buy stocks. FOMO, the fear of missing out, is everywhere you look. Social media is filled with success stories and get-rich-quick narratives. Everyone thinks they're going to be a millionaire. And now, right now, at this exact moment, Morgan Stanley comes out with their most bullish forecast. They need you to be the buyer. They need your money flowing into the market because they are the seller. Their institutional clients are distributing positions and they need someone to sell to. But here's where it gets really dangerous. Here's where this cycle is different from previous crashes, and why you need to pay very close attention to what I'm about to tell you. In past market crashes, there was a playbook for survival. You could go to cash and wait it out. Government bonds offered a safe return. Treasury bills paid interest. Savings accounts, while not exciting, at least preserved your purchasing power. You could sit on the sidelines, let the storm pass, and re-enter when valuations became attractive again. That was the game. Not anymore. That playbook is obsolete. The rules have fundamentally changed. Global debt levels are astronomical. We're talking about debt that has accumulated to levels never seen in human history. Government debt, corporate debt, consumer debt, it's everywhere and it's massive. Central banks have printed more money in the last 5 years than in the previous 50 years combined. The money supply has exploded. The balance sheets of the Federal Reserve, the European Central Bank, the Bank of Japan, they're all bloated beyond recognition. When this stock bubble finally pops, and it will pop, the central banks and governments can't let a normal deflationary crash happen. They can't allow it. Why? Because deflation would destroy the government's ability to service this massive debt. If prices fall and the currency strengthens, the real value of the debt becomes unpayable. Governments would default. The entire financial system would collapse.
Buy now!
So,
Bull
what will they
run
do
continues!
instead? They'll do the only
Invest
thing they
now!
can do. They'll print more money. They'll stimulate harder. They'll throw everything they have at preventing deflation. They'll create new programs, new facilities, new ways to inject liquidity into the system. They'll debase the currency further and further until the real value of the debt becomes manageable. What this means for you is critical. You need to understand this. You're going to face a stock market crash and currency debasement at the same time. It's a double trap. Your stocks will fall in nominal terms. You'll watch your portfolio value decline. But here's the nightmare. Your cash will lose purchasing power even faster. The dollars sitting in your savings account, the ones you think are safe, will be worth less and less as inflation accelerates. You'll be losing wealth in both directions. This is the scenario that almost nobody is prepared for. This is the trap within the trap. This is where silver comes into the picture. And I need you to understand that silver isn't just another investment option. It isn't just a precious metal that sounds interesting. Silver is potentially the most undervalued hard asset on the entire planet right now. And there are very specific reasons why the smart money is already accumulating it while telling you to buy stocks. Let me break down exactly why silver is different and why it matters right now. First, they can't print it. This is fundamental. Fiat currency, the Federal Reserve can create trillions of dollars at the push of a button. It's digital. It's infinite. There's no limit. Stock prices, companies can inflate those through buybacks, through financial engineering, through multiple expansion. They can manipulate valuations. But silver? Silver has to be physically mined from the ground. It takes real energy. It requires actual labor. It demands capital investment. You can't create it out of thin air. When the money printer goes into overdrive, when they're creating currency at unprecedented rates, silver goes up. It has to. It's math. Second, industrial demand for silver is absolutely exploding, and this is something most people have no idea about. Silver isn't like gold, sitting in vaults doing nothing. Silver is consumed. It's used up in industrial applications at rates we've never seen before. Solar panels use massive amounts of silver in their photovoltaic cells. Every panel requires it, and the solar industry is growing exponentially. Electric vehicles require 3 times more silver than traditional combustion engine cars. 3 times. And EV adoption is accelerating globally. Every smartphone, every computer, every electronic device you use contains silver. The conductivity and properties of silver make it irreplaceable in modern electronics. And now with 5G infrastructure being built out worldwide, we're seeing unprecedented demand for silver in telecommunications technology. Here's the critical part. Unlike gold, which mostly sits in central bank vaults and gets recycled, silver is being consumed. It's used in applications where it can't be recovered. It's gone forever, and we're facing a massive supply deficit. The amount of silver being mined each year is less than the amount being consumed by industry. The above-ground stockpiles are being drawn down. This is an unsustainable situation that has to resolve itself through higher prices. Third, the gold-to-silver ratio is absolutely screaming at us right now. Throughout most of recorded history, the ratio of gold to silver has been somewhere between 15:1 and 20:1, meaning it took 15 to 20 ounces of silver to buy 1 ounce of gold. Today, we're looking at a ratio around 85:1. Silver is massively, historically, absurdly undervalued relative to gold. When this ratio corrects, and it always corrects eventually, the gains in silver will be multiples of what you'd see in gold. This is basic mean reversion. This is one of the most compelling value propositions in all of financial markets right now. Fourth, and this is crucial, silver is the people's money. It's money that Wall Street can't fully control. Sure, they have their ETFs. They trade paper contracts. They play games with derivatives. But physical silver in your possession? That's outside their system. That's beyond their manipulation. When confidence in the financial system cracks, when people start to doubt the institutions that have betrayed them repeatedly, they want real assets. They want things they can hold. And silver is affordable enough for regular people to accumulate meaningful amounts. You don't need to be wealthy to own 50 or 100 ounces of silver. It's accessible. It's democratic money. So why now? Why is this Morgan Stanley Bullish call the signal? Because we're at that critical point where institutional players need maximum participation to complete their distribution. They need the greatest fool. They need someone to sell to at those prices. Look at retail investor sentiment right now. It's euphoric. Everyone thinks they're going to get rich. The fear of missing out is overwhelming. Look at margin debt. It's elevated to dangerous levels. People are borrowing money. They don't have to buy assets at prices that don't make sense. Look at speculative positioning. It's extreme by every measure. The warning signs are flashing everywhere. Now contrast that with silver. What's the sentiment around silver? It's low. Most retail investors aren't even thinking about it. Positioning is cautious. The metal has been ignored, overlooked, dismissed as a relic of the past. And that's exactly where you want to be. Not where everyone is going, but where nobody is looking yet. The Morgan Stanley call is the dinner bell. They're ringing it loud and clear to gather the last wave of buyers before the smart money heads for the exits. They need your capital flowing in so their capital can flow out. It's that simple. It's that cynical. And it works every single time because human psychology doesn't change. Now, let me be clear about what I'm actually suggesting you do, because I'm not telling you to panic or make rash decisions. I'm not saying sell all your stocks tomorrow morning. I'm not suggesting you liquidate everything in a rush. But I am telling you to recognize what phase of the cycle we're in. I'm telling you to be strategic and thoughtful about what comes next. If you have
Look at this
significant
upward
gains
trend
in
here.
overvalued
It could indicate a
stocks,
significant
or
market
positions
shift.
that have run up dramatically, start taking some profits off the table. Not all at once, not in a panic, but systematically. Scale out of your winners, lock in some gains. Don't be greedy. Reduce your exposure to extreme valuations. Those meme stocks trading at absurd multiples, that unprofitable tech company with no path to earnings, those speculative positions that only make sense if everything goes perfectly. Those are the ones that will be absolutely destroyed in the next downturn. They'll lose 80-90% of their value. Don't be holding those when the music stops. Start accumulating physical silver. And I need to emphasize this, not ETFs, not mining stocks initially. Physical silver, actual coins and bars that you can hold in your hand. Take delivery. Hold it yourself or put it in allocated storage that you control. This is important because when the system is under stress, you want to own real assets, not paper promises. Start with what you can afford. Even 10 or 20 ounces is better than zero. You don't need to go all in on day one. Build your position over time. Dollar cost average, if that makes you comfortable. The point is to start accumulating while nobody else is paying attention. And here's a mental shift that's crucial. Start thinking in ounces, not in dollars. Your goal isn't to make money in dollars that are being systematically debased. Your goal is to preserve and grow real wealth, measured in ounces of precious metals that can't be printed or inflated away. When you change your measuring stick, everything looks different. Finally, ignore the noise. When silver corrects, and it will because all assets correct, the financial media will say, see, we told you precious metals were a bad idea. When the stock market crashes, those same voices will claim, nobody could have seen this coming. They'll gaslight you. They'll rewrite history. Don't listen to them. Stay focused on the long-term trends that actually matter. Currency debasement isn't stopping. Industrial demand for silver isn't decreasing. The historical role of silver as real money isn't changing. These fundamentals remain intact regardless of short-term price volatility. Look, I know this sounds conspiratorial. I know it's easier and more comfortable to just trust Morgan Stanley. To follow the crowd into stocks. To believe that this time really is different and the bull market will continue forever. It's easier to assume that the big banks have your best interests at heart, that they're giving you honest advice, that you're all on the same team. But history doesn't lie. History doesn't repeat exactly, but it rhymes. And this pattern has played out over and over and over again throughout financial history. The banks make their most bullish calls at the top. Retail investors, believing the narrative, pile in with their savings. The crash comes, seemingly out of nowhere. Wealth gets transferred from those who trusted the system to those who understood how the system actually works. The difference this time, the thing that makes this cycle uniquely dangerous, is what happens after the crash. In previous downturns, you could hide in cash or bonds and wait for the storm to pass. The currency debasement that follows this crash will be unlike anything we've seen in modern history. The money printing will be extraordinary. The inflation will be persistent and destructive. And when that happens, when the full force of that debasement hits, you don't want to be holding paper promises. You want to be holding real assets that governments can't print and central banks can't inflate away. Morgan Stanley is telling you to buy what they're selling. They're encouraging you to become the exit liquidity for their institutional clients. The smart money, the people who actually understand how this game is played, are buying what Morgan Stanley and their peers can't print. They're accumulating physical silver while it's still affordable, while sentiment is still negative, while everyone else is distracted by the stock market euphoria. Silver isn't just a hedge against the coming crash. It's not just insurance. It represents a transfer of wealth from a system that's rigged against regular people to an asset you actually control, an asset with real industrial demand, an asset that's been money for thousands of years. An asset that can't be debased or manipulated in the same way paper assets can. They're lying to you. The bullish forecast isn't for your benefit. The optimistic outlook isn't based on genuine analysis. It's strategic. It's calculated. It's designed to get you to do exactly what serves their purposes, not yours. But now you know the truth. Now you understand the game. Now you can see the trap for what it is. The choice is yours. You can follow the crowd into overvalued stocks at exactly the wrong time. Or you can position yourself for what's actually coming. You can be the exit liquidity the institutions need, or you can be accumulating the assets they desperately wish they had more of. The clock is ticking. The warning signs are all around us. Morgan Stanley just rang the bell. The question is, are you going to answer their call, or are you going to make the move they hope you won't? The smart money has already decided. They're buying what can't be printed while telling you to buy what they're selling. Now you know what they know. What you do with that information is up to you.